Hey, what's up guys? It's Michael here, and in this video we're going to look at the most recommended ETF in the financial independence community. That's right, VDHG from Vanguard. And we're going to compare it with its rising competitor DHHF from BetaShares to settle the debate of which one is the ultimate all-in-one set and forget ETF. We'll look at everything from their differences, their pros, their cons, how to start investing in them, and then finally some alternatives that are really worth considering. Now, I'm sure most of you will know taking the plunge and deciding to invest is not easy. And then deciding what to invest in, well, that's even harder, as these days there are so many different options of things to invest in, from equities, bonds, property, crypto, and always the like button for the YouTube algorithm. And this is where the concept of the all-in-one ETF comes into play. Multi-asset exchange-traded funds, ETFs, offer to do all of the hard work for investors. These funds blend different growth and defensive asset classes like equities, bonds, and cash into a single product by investing in a handful of different funds. There's lots of different types of these multi-asset funds available, and they're constructed to cater for differing risk profiles like conservative, balanced, and high growth, similar to products offered by a lot of superannuation funds. Now, I know you might be wondering, what is an all-in-one fund? Well, in essence, they're essentially a fund of funds, or an everything index. The difference between this and a regular ETF is that a standard ETF will be tracking a single index and investing directly into stocks, whereas a multi-asset ETF doesn't actually invest directly into stocks. Instead, it is investing in multiple ETFs or funds which themselves hold stocks directly. And this is actually where an active element comes into play, as there has to be some decision around which funds to use and at what allocation percentages. Where some people will focus on stock picking or market timing, most of a multi-asset portfolio's long-term returns are driven by those asset allocations. However, even with this active component, all-in-one funds are very different to just picking individual stocks. It's essentially the same concept of you choosing your own portfolio of ETFs, except it's going to be way simpler to manage. You don't need to worry about rebalancing and sticking to those set percentage allocations, and it removes the risk of any potential self-sabotage behavioural risk. For example, you might observe on the news one day that Australian stocks are crashing and decide at the time to lower your allocation in Australian stocks in your ETF portfolio, which would be a horrible mistake and kind of the definition of bad market timing and selling low and buying high. And this is really made clear when you look at the performance of the average investor who does their own stock picking and trading. When you look at the data over a 20-year period, the average investor underperformed almost every asset class with a return of just over 2% per annum, underperforming bonds, gold, and of course the S&P 500, which returned almost 10% per annum over the same time period. Furthermore, even the majority of investment professionals who spend their entire time trying to outperform the stock market every single day aren't able to consistently beat it over a long period. In a study done by the S&P over a 20-year period, across all US funds, only around 14% of portfolio managers were able to outperform the index that they were being benchmarked against. Which is kind of ludicrous when you have to consider the fees that they charge are often 10 times the fees of a passive index or ETF. Whilst a fund manager might outperform the market for a year or two if they're lucky, as you extend the time period, you observe the percentage of fund managers who are beating the index gets smaller and smaller. For example, with large cap funds, over a 1-year period, 64.5% of active funds underperform the index. After 10 years, this moved up to 85%. And then after 15 years, over 90% underperformed the benchmark. And I'm sure if you extend this out further, we will definitely begin to approach an extremely small percentage of funds that are able to consistently outperform the market. And this is really where the all-in-one fund comes into play as the simplest way to ensure you stick to a diversified passive investment strategy. As we just established that stock picking is going to severely underperform the market, along with actively managed funds. Now, for the longest time, there has been a single fund that has been consistently recognized as kind of the holy grail of passive investing, which is the ETF called VDHG by Vanguard. And this stands for Vanguard Diversified High Growth and is comprised of 7 other Vanguard funds. An important distinction to make here is that they are Vanguard wholesale funds, not ETFs, and I'll explain why this is so important shortly. And the 7 underlying funds in VDHG are the Vanguard Australian Shares Index Fund, the Vanguard International Shares Index Fund, the Vanguard International Shares Index Fund Hedged, the Vanguard Global Aggregate Bond Index Fund Hedged, Vanguard International Shares Companies Index Fund, the Vanguard Emerging Market Shares Index Fund, and finally the Vanguard Australian Fixed Interest Index Fund. Oh man, I feel like I just said Vanguard like a million times. Okay, and across these 7 funds, there's actually over 7,000 individual companies you're diversified across. In addition, that 10% allocation to bonds. And whilst this seems pretty complicated, at a high level, you're essentially getting exposure to Australian large caps, international large caps, international small caps, emerging markets, and bonds. Or if you want it simplified even further, it's 36% Aussie equities, 54% global equities, and 10% bonds. And the only notable asset class missing from this VDHG ETF is something to give you property sector exposure through something like the Vanguard Australian Property Fund or the VAP ETF. And if you look at the performance of VDHG, well, it's done really well in the bull market of the past year. It returned over 26% in the year ending August 2021. And while the ETF version of the fund launched in 2017, the identical unlisted wholesale fund by Vanguard has returns going back all the way to 2002, and it's returned 12.2% annually the last 10 years and 7.66% annually over the last 15. It has an annual fee of 0.27% per annum, which to put things in perspective would cost you $2.70 for every $1,000 you have invested every year. And in case you were wondering, because I definitely was, Vanguard is not double dipping on management fees here, as in you aren't having to pay for the management fee from the funds inside VDHG and then paying another fee for VDHG itself. If you look at the PDS for VDHG, it reads, as the funds invest in a number of underlying funds, Vanguard's management fee in the underlying funds is fully rebated back to the funds. This ensures investors do not pay duplicate fees. And you may have already realized this, but since all VDHG is doing is investing in other publicly available Vanguard funds, there's nothing stopping you or I for investing in them directly. And if you did this, you'd actually end up at a blended management fee of around 0.19%, a pretty significant difference to the 0.27. That difference of 0.08% per annum is what Vanguard takes to automatically balance the funds for you and remove that human element risk, which for a lot of people is worth it, as it's a lot simpler to manage and it just means you're way more likely to stick to those allocations. And remember when I said earlier that VDHG isn't holding ETFs inside of it, and instead it's holding those unlisted wholesale funds? Well, this is important as there's actually a negative tax implication associated with these unlisted managed funds. In a managed fund like the Vanguard wholesale funds, all of the money is pooled together from investors. So if any single investor sells units, it triggers a capital gain event for all of the investors in the fund, which means even if you didn't sell out of the fund, you'll still have to incur the tax liability of any capital gains. And this doesn't occur with ETFs due to their differing tax structure, where you only realize capital gains when you actually sell your own ETF holdings. So if you have a relatively high marginal tax rate and you didn't plan on selling and realizing these capital gains until your tax rate was lower, this is kind of a big deal and is actually a pretty big downfall of VDHG and other unlisted managed funds. Now, given the massive popularity of VDHG and passive investing, it didn't take long for another competitor to come along and shake things up. This competitor being the DHHF ETF from BetaShares, which has its own spin on the all-in-one set and forget ETF. There's 4 underlying funds in DHHF, and this time they're actually ETFs, with over 8,000 individual stock holdings between them. These ETFs are the BetaShares Australia 200 ETF, A200, the Vanguard Total Stock Market ETF, VTI, the SPDR Portfolio Developed World ex-US ETF, SPDW, and the SPDR Portfolio Emerging Markets ETF, SPEM. And just going through these ETFs, starting with A200, well, it provides exposure to the largest 200 companies on the ASX, and DHHF has a 37% allocation towards it. Given that the Australian market only accounts for roughly 2% of the world's global economy, this might seem like a bit of an over-allocation. However, given that Aussie shareholders receive higher dividends than those offered by other markets in the world, in addition to receiving tax benefits through the franking credit system, this often makes investing in the ASX an appealing prospect for Aussies, which is why there's a bit of an overweightage here. The next ETF in DHHF is VTI, which tracks the total US stock market and provides exposure to large, mid, and low cap companies in the US, with DHHF allocating 34.9% of the portfolio towards it. And given that the US accounts for almost 1/4 of the world's global economy and has remained the largest economy since 1871 till now, this is why it makes sense for a diversified portfolio to have a significant US allocation like this. The next ETF is SPDW, which provides exposure to developed markets outside of the US, and DHHF has a 20.7% allocation to this. And this just prevents you having an over-concentration of the US market in this portfolio. And this might seem foolish since the US has performed so well, but we never know which assets are going to outperform in the future. So as a part of a diversified strategy, it's important to make sure you have exposure to all markets. And then finally, SPEM rounds out the funds in DHHF with a 7.4% allocation. And this is really used to get exposure to emerging markets. The top weighted countries in SPEM are China, Taiwan, India, Hong Kong, and Brazil. And since these economies are new and have a lower overall market cap, their growth potential is typically higher than those in developed markets. Again, at a high level, this rounds out to DHHF having a 37% allocation towards Australian equities and a 63% allocation towards global equities. Notably, there is no allocation towards bonds here. And moving on to fees, DHHF has a management fee of 0.19% per annum or $1.90 for every $1,000 invested per year. The lowest fee from an all-in-one diversified ETF currently available on the Australian market. However, this fee is effectively closer to 0.28% per annum due to a concept called tax drag, which I'll explain in detail shortly. And again, in case you're wondering, BetaShares did confirm via a post on their Reddit account that the management fee of 0.19% per annum is all inclusive of the fees of the underlying ETFs, and like VDHG, they are not double counting on fees. Now onto the performance of DHHF. Well, it's only been around since December of 2019, which means it doesn't have a long track record to look back to. But if you look at its underlying holdings, it will perform very similar to VDHG, but probably slightly more volatile, higher highs and lower lows due to it not having any bond exposure. As of today, since inception, DHHF has returned 19.5% per annum. Okay, if you're trying to decide which one to invest in, well, it really comes down to four main differences between VDHG and DHHF. The first being the fact that one has bonds and the other doesn't. VDHG has a 10% allocation towards bonds and DHHF has a 100% allocation towards equities. Bonds sort of act as an insurance policy against volatility or market downturns, as they often become more valuable during these times. However, during times of growth, which is the majority of the time with the stock market, bonds are going to significantly underperform equities. Therefore, if you're planning on investing on a long time horizon, BetaShare recommends 7+ years here, then 100% equities may be the right choice for you, as over the long run, the returns will most likely be higher than if you had a 10% allocation towards bonds, like in VDHG. The second major difference between VDHG and DHHF are the fees of 0.27% and 0.19%. And as I mentioned earlier, since DHHF contains SPDW and SPEM, which are US domiciled funds that contain non-US assets, they actually incur something called tax drag, which occurs when an Australian fund holds US funds that hold stocks from non-US countries, as you can't claim the dividend withholding tax credits paid by the US fund that you normally could if your Australian fund held those non-US stocks directly. And what this actually means for you is that the management fee of DHHF is effectively much closer to 0.28%, which means it really isn't that different to the fee of 0.27% of VDHG. And this actually brings us to the third major difference, and that's the fact that VDHG holds managed funds and DHHF holds ETFs. As I explained previously, managed funds are less tax efficient than ETFs, as you don't control when you get to realize capital gains. By investing in a fund that exclusively holds ETFs, however, such as DHHF, these gains are not realized until you choose to sell, and as a result, there is more potential for capital growth due to the full fund being able to compound over time. And by the time you actually want to start selling units of your ETF, it's much more likely that you would be in a lower tax bracket than you would be during the accumulation phase. And the fourth and final difference between VDHG and DHHF is hedging, where VDHG has an allocation towards hedge investments and DHHF does not. Hedging, very similar to bonds, is like an insurance policy, except this time to offset the impact of currency fluctuations. Over the long run, we typically see currency fluctuations balance out, and it's usually not worth the additional cost in management fees. So personally, given the potential tax implications and my long-term investment horizon, for me, DHHF is a no-brainer. But regardless of which one you end up going with for your own individual situation, the bottom line is that both are great investments and will mean you're going to significantly outperform an average investor trying to pick their own stocks. However, I will now go through some alternatives if you don't mind putting in a bit of extra work to save more fees. But with auto investment tools like Pearler available, the historical challenges of balancing a multi-ETF portfolio are almost gone, and it's basically as easy as holding VDHG directly. However, just quickly, if you're watching this and you haven't actually started investing yet or want to know how to get started in investing in ETFs, well, it's really not that complicated. All you need to do is sign up for a brokerage account, deposit your funds, and purchase your ETFs. But if you do want a detailed step-by-step guide on how to get started with investing, check out my beginner's guide, which I'll link above. Now, like I said, there's a much simpler and cheaper alternative to getting a diversified ETF portfolio by using just 2 ETFs. This is through the BetaShares A200 ETF at 25% allocation and the Vanguard International Shares Fund VGS at 75%. And this will just give you 75% global exposure and 25% Aussie exposure. And the fees here are much lower, as A200 has a fee of 0.07% per annum and VGS has a fee of 0.18% per annum. If you want to know more details about this 2-fund portfolio, well, check out the link in the description, and I'll link it above as well, where I go over what the benefits are and why this portfolio makes a lot of sense. And why this is actually so easy to do now is because of tools like Pearler, like I mentioned, which have this auto investment option. And if you don't know what Pearler is, well, it's essentially a stockbroker available on the ASX that has that auto investment feature that allows you to configure predefined investment instructions to automate your investing. Essentially the same way as an all-in-one ETF does the same thing like VDHG. So you can literally just tell it to invest in A200 25% and VGS 75%, set up your deposit schedule, and it will balance it automatically for you. You could even set up the VDHG ETF, like I mentioned before, with significantly lower management fees via this method as well. And if you do want to sign up to Pearler and check it out, feel free to use my link below where you'll get a brokerage-free trade for signing up. And in addition, if you want to see a review first, I've done a very comprehensive review on Pearler and all its features, which I'll also link below as well. So in the end, no matter which strategy you end up choosing, or whether you go with DHHF or VDHG, they're both going to be great options. And if you do choose to build your own all-in-one ETF portfolio, well, it's a lot easier these days due to those auto investment tools like I mentioned. As long as you avoid picking too many individual stocks and trying to time the market, well, you're going to outperform most investors out there, and you're even going to outperform most professional investors out there as well. So with that said, guys, thanks so much for watching the video. As always, smash that like button, subscribe, and hit the bell for notifications, and leave a comment if you got any questions. I do try and answer most of them. Have a great one, and I will catch you in the next video.